very much. Well, at Baillie Gifford, we focus very much on decades rather than quarters. And over that period, we think we're going to see a number of revolutions that, in our view, are being massively underestimated by the capital markets. So I thought we'd just start by taking a look at a few of those. And here's the first one, the biggest information explosion for 500 years. So in the 15th century, the printing press connected people on a completely unprecedented scale. That triggered social, cultural, scientific revolutions all over the world. But we've now got another information revolution because every year humanity is producing 1,000 times more transistors than grains of rice and wheat combined. And, I think it's pretty widely recognized that these transistors are throwing off a lot of data, but we think that the consequences of linking those expanding data sets with massive leaps forward in computing capacity are being massively overlooked because Moore's law is here to stay. We're large shareholders in a company called ASML, and they make the lithography machines that underpin the shrinking chip sizes. And when their chief scientist tells us they've kind of figured out the science for the next 10 to 15 years, that really matters because it translates into a 60-fold increase in computing capacity over the next decade or so. And, it's impossible to gauge the exact implications of that. But we can be pretty sure that entire industries are going to be turned upside down. And we just don't think the financial markets are pricing that in at all. So, let's imagine a few possibilities in food and farming, for example. What happens when tractors equipped with computer vision that can distinguish between a weed and a crop can identify and pull weeds out of the ground at ever increasing speeds? That probably destroys demand for herbicide and pesticide. What about progress in the field of synthetic biology? We've got machine learning allowing companies like Ginkgo Bioworks to develop exponentially cheaper lab-grown meat substitutes, which in 10 years' time could be much cheaper and taste exactly the same as farmed meat. And that eliminates billions of tons of carbon, probably also destroys several trillion dollars of market capitalization. And then you've got, food distribution. We regularly meet with the founder of Meituan. This is a Chinese online food delivery company. He's planning to use drones to deliver about 100 million meals a day in a few years from now. And because a lot of people in tier 1 cities are now ordering 3 meals a day online, you've got apartment blocks being built with no kitchens. And that's pretty bad news for the white goods companies that make the cookers and fridges. And then, let's turn to transport. What happens, with autonomous EVs? How much of the auto insurance industry is destroyed in the next decade or two? How much less confectionery will be bought when people no longer need to stop at gas stations? Then healthcare. What happens when machine learning-based consultations are combined with gene-based therapies? Well, the business models of traditional pharmaceutical companies probably roll over pretty quickly. And, none of this stuff fits the nice spreadsheet models of industry specialists at investment banks. And I think that's why they failed so badly to get their heads around companies such as Moderna and Tesla in recent years. These companies using a first principles software-driven mindset to completely reinvent old-fashioned industries. So you've got huge chunks of the index destroyed and huge opportunities being thrown up by continued advances in computing power. And then we've got another big shift. To our minds, the decline of fossil fuels seems likely to come about much more quickly than widely expected. And that's thanks to the year by year, decade by decade efficiency improvements in renewable energy. And the pricing of renewables continues to fall with scale so convincingly, it's actually becoming pretty embarrassing for traditional forecasters. They just don't seem to be able to grasp the exponential nature of this growth. And I think that's progress is exactly why the market cap of the entire US energy sector is now less than the market cap of Amazon. And I think it's why it's so dangerous to wait for some kind of reversion to the mean. And it's why we're thinking hard about the second order effects of abundant free energy on a 10-year view. And then you got the third big shift. The economic center of gravity is moving rapidly back towards the east. So it makes sense to look to China and Asia more broadly for a glimpse of where the future changes lie. And when you add all these changes together, that requires a massive shift in mindset. The index incumbents have never looked more vulnerable and dangerous. So you've got trillions of dollars of market cap vulnerable to huge disruption. Companies are going to need a huge amount of adaptability to navigate these changes. And I think we're going to see a really big polarization between the companies that can successfully navigate that shift and those that fail to do so. So the gap between the winners and the losers, to our minds, seems quite likely to widen a lot. But actually, the interesting thing is stock market returns have always been really skewed. And you can see this from this chart here. And it's based on the work we've been doing with a Swedish professor called Henrik Bessenbinder. And it's really important because what it shows is that a tiny number of very big winners drive all of the equity market returns. So this data set for global equities is between 1990 and 2018. There are about 61,000 companies in this data set. And when you rank them by return, the amazing thing is you find 61% of them have destroyed value. You need another 38% of them to make up for that value destruction. And you end up with a situation where just 1.3% of companies have driven the $45 trillion of net value creation over that time period. So as investors, we need to be prepared to embrace extremes. And at Baillie Gifford, we've been trying really hard to rewire our thinking to give ourselves the best possible chance of finding those big winners. And that's kind of meant really embracing this kind of asymmetric payoff structure. So these are the returns that have been delivered by the stocks that we've held within one of the portfolios that we manage at Baillie Gifford. Just a small handful of multi-baggers at the top there dominating. Amazon up 85-fold during our holding period, Tesla up 70-fold, Tencent up 25-fold. And I think the shape of this chart shows the amazing thing about equity investing. You can see that just one of those big winners is enough to offset all the ones at the bottom there that have gone down. So that skew of returns is massively underestimated. Now, how can an investor take advantage of that? Well, I think to capture one of those big outliers, you need to rewire your thinking in three different ways. Firstly, spend a lot of time imagining what can go right rather than just focusing on the downside. Get into a mindset where you worry about missing out on one of those big outliers much more than holding a stock that goes down. So when you ask your equity managers about their biggest mistakes, ask them about the stocks they should have bought but didn't. Ask them about how they stress test the upside to make sure they don't miss out on a multi-bagger, because the opportunity cost of that is enormous. And secondly, I think we need to imagine future possibilities, where a company's culture might take it, rather than just doing the easy bit, which is analyzing existing revenue streams. So, ask what if. So if you think there's, say, 25% chance of a stock going up 20 times and a 75% chance of it going down to zero, then you should buy that stock every time, even if it feels uncomfortable. And thirdly, stay the course. Stay the course for many years to enjoy the compounding, because if you constantly trade in and out of companies, you're going to miss those asymmetric returns. And investing in this way presents this wonderful opportunity to build really enduring relationships with the world's greatest visionaries. Our average holding period is around the 10-year mark, so about 20 times longer than the stock market average. And creative destruction is really a nice, smooth, linear process. Those with a long-term vision want patient capital that won't run away at the first sign of bumps in the road. Any investor who demonstrates real patience will be rewarded with great access to management teams. And this slide just shows a small handful of the founders that we enjoy conversations with. And they appreciate that we spend our time talking to them about their prospects for 2030, rather than asking for quarterly earnings estimates. And they also appreciate that we back them through periods of volatility. So our holding in Tesla, for example, has had 7 drawdowns of over 30% over the last 8 years or so. The share price of NIO, the Chinese electric car company, fell 85% after we bought it at IPO, before then rallying 4,000%. And these periods of volatility present the most wonderful opportunities to strengthen our relationships with company management teams by encouraging them to remain focused on the long-term vision, and often for us also to buy more shares. So as you can tell, we spend a lot of time thinking about corporate culture. But corporate culture doesn't show up in a P&L or a balance sheet. You can't put it into a spreadsheet model. So the stock market's not very good at assessing it. And the opportunity, I think, from here is in recognizing that stock picking is actually more about anthropology. And that links into the next massive opportunity, because most people in our industry are using exactly the same information sources as each other. So, look how narrow-minded it is. Almost everyone is using information from within that little oval on the left-hand side, which circles the investment banks in London, Frankfurt, and New York. But look how at odds that is with where the action is happening. There are more people living inside that circle on the right-hand side than outside it. So we have this wonderful opportunity to use radically different information sources. And we try really hard to surround ourselves with perspectives from people who come from completely different walks of life. The scientists pioneering new gene sequencing techniques, the academics who are studying how machine learning ethics might evolve, the authors from book festivals, urban geographers, historians, mathematicians, climate change physicists. And none of these people or information sources is going to give an investor an answer, but together they help us build this wonderful mosaic of possibilities and probabilities. And that's why, I think as an investor, you want to make sure you're not just recruiting people who've all studied finance at university. We have people who study history, philosophy, medicine, music. I'm an aeronautical engineer. So you need that cognitive diversity to give yourself a better chance of being roughly right over the next decade than precisely wrong over the next quarter. And then we come to this other opportunity that we think only presents itself to very long-term investors. This slide shows just a handful of the businesses that we've held at Baillie Gifford while they were still private and in the very early stages of attacking intangibly large end markets. And a number of them are still private today. They've chosen to stay private for much longer than might historically have been the case, because their input costs are deflating with Moore's law, so they can grow very rapidly with not much need for capital. But also because by remaining private, they can choose their shareholders. And what we're finding is that more and more private companies will approach long-term investors directly or via introductions from other private companies, because they want long-term support. For example, we had 500 direct approaches last year alone. So we have this wonderful chance to tap into the next generation of companies earlier and to enjoy the increasingly large returns that are accruing, I think, in the private markets. So there's this great opportunity to crack open this false delineation, increasingly false delineation between the private and the public markets, and also to completely disrupt the fee structures of the venture capital industry. You've got to bring fees down to democratize access to the next generation of the world's most exciting private companies. There is absolutely no reason why this needs to cost 220. So bringing this all together, here's the kind of portfolio that I think we want to be building against the backdrop that I've described. One that looks nothing like the index, one that has very low turnover, and one that's all about the future. These are the companies that are helping to shape the future of food, the future of finance, the future of healthcare, the future of work, the future of mobility. And they all have the potential to grow to many multiples of their current size. And that's the kind of asymmetry that we're looking for. And I think what's interesting is that in aggregate, the share prices of these kinds of stocks haven't kept up with fundamentals. And that surprises a lot of people. So this group of companies, for example, has delivered performance of collectively just under 30% per annum over the last 5 years. But the revenue growth in those companies has been almost 40%. In other words, the portfolio is derated, and that's in very stark contrast to the index. And so I think, a long-term investor here with this sort of mindset can enjoy some fabulous returns to scale. The market just isn't close to grasping the scale of the visions and of the founders that sit behind these companies. So we're really excited. We think it's still day one, and by approaching stock picking in a prudent long-term way, you can come up with a group of companies that is uniquely well placed to navigate a decade of really, really massive change, as I've described. So hopefully that observation sort of sets the scene for some useful Q&A, and look forward to the discussion later on.